I would like to, greetings, my name is Muindi Brian. As the MC has said, I was the chair emeritus. I have the difficulty of having my current boss, the chair, Mr. Paul Kavuma, on my panel. I will ask that each of them introduces themselves, starting from stage left, and then all the way down. So, Paul.
Yes, my name is Paul Kavuma. I've been in my initial early career as in mergers and acquisitions, and then in the private equity industry, and now managing Construkt Africa as a recently licensed REIT manager here in Kenya.
Thanks, Paul. I'm Graham Reed. I must say I was terrified that Brian was going to make me dance. White people don't have rhythm. So, my career, I started I'm a reformed lawyer. Worked in development in the not-for-profit sector in NGOs. After 1994, in the Johannesburg Metropolitan Council. And I'm currently the CEO of Talisi, which is not a REIT, but we are home to the first dollar-denominated REIT to list and the first industrial REIT to list.
Thank you, Kavuma. We also have Sean online. Can we please unmute Sean so he can introduce himself? Sean, go ahead.
Good afternoon, everyone. My name is Crispus. I am the co-founder of Nesty. I've spent the better part of the last decade in my career sitting across the table from Kenyans who want to own a home. In the process of that, we've worked with several financial partners as well as developers to make this happen. And what's been interesting is that not only have I learned about property and finance, but then I've also seen what it looks like for other people to be left out of that process. So essentially, we're talking about gig workers, entrepreneurs, basically anyone who doesn't have a pay slip. So that in itself is what led us to build Nesty. So at Nesty, what we're doing is we're helping Kenyans turn their rent payments into a verified financial identity, whereby they get to build a rent score, and they can use this rent score to now access credit opportunities as well as housing opportunities with the banks and developers through rent to own.
Good afternoon. Okay, thank you. So my name is James Waswa. The face is different from what is on the poster for sure. I'm stepping in for Crispus. I'm an asset manager and REIT manager at Sterling Real Estate Management Limited. What we do as a company, we are a third-party REIT management company. We advise promoters on how they can make their assets viable to enter into a REIT. So we do pre-REIT viability assessment for our assets, and also once they are onboarded onto the REIT, we manage the assets on behalf of the trustees. And also we also, as part of our mandate, we also assist in asset optimization and advisory for a different range of clienteles. Yeah.
Thank you, James. And as I said, my name is Brian. I'm a legal advisor. Okay. Paul, I want to start with you, since you came up with the theme for this year's conference. So just building on that, I want to ask you about the innovations in the real estate sector. What you think is the most significant innovation in the real estate sector from your perspective?
Okay. Thank you. Okay, can you hear me? Maybe a little bit more volume, please. Yeah, look, I mean, REITs are the most innovative thing that's happened in the real estate sector. And, but to broaden that, you know, the growth of REITs is going to be a factor of the ability of managers or to be able to deliver institutional grade product that has a clear path towards aggregation, scaling, and liquidity. And that's the conventional approach to REITs. The nuance I would introduce for Africa, and I'll offer Kenya as a site example, is that, as Raghav said a little bit earlier, he said that, I think he said 90% of real estate is not institutional grade. So if we're trying to create institutional platforms, you're really looking at 10% of the market in terms of product. So there is a scarcity, in my view, of institutional grade product. So the core to growth of the REIT industry, in my view, is the development of institutional grade product. So where I had a slight probing with Raghav, who just came in now, was a little bit earlier, was to say that actually development REITs or development of real estate has to be a core driver of deepening and the innovation. And I just want to share some statistics a little bit, because we have to. This will inform strategy for the market, in my view. If I look at a South African market, we had somebody from the South African market earlier. 70 to 85%. Most of the pension funds, their policies, speak to a 70 to 85% core income portfolio. They want yielding. Exactly what Raghav had in column B is what most of the institutional investors in that market look for. But then you go to India, Mexico, some of them, it's closer to sort of 50 to 60% is core income, and the balance is D, is development. And then you go to our friend from Ghana, came a little bit earlier, he's developing 40 acres in downtown Accra. And the truth is that, most of our, for us to really deepen the REIT market, we're going to have our pension funds and institutions and managers doing more D, more development. And if I look to Nigeria and Ghana, it's more like 60%, 50 to 60% is development and not income. Okay, and if that's the case, then the innovation that needs to come, or the imperative that needs to come, is for more of our institutional investors in this market. D risk is higher than I risk. And so if we don't have our domestic investors involved, I don't think we'll deepen the market fast enough. So that means that our actuarials that are developing policies and investment policies for our pension funds has to weight the allocations more towards development. That means our fund managers have to be more specialized, because development of product is more complex than managing existing yielding income generating assets. So to me, that's where we've got a head start, because we do have D-REITs in this market, and we have a propensity to like to develop real estate in our markets. So to me, that's where the biggest innovation needs to come.
Okay, thank you. Grima, just building on what Paul has been mentioning. In the morning session, we heard a lot about this alternate asset classes, industrial REITs, student housing, retail. In your view, what emerging asset classes are most likely to scale in this market? And what do you think the significant factors for that would be?
So, I don't know if you can hear me, and I'm told I mumble. Hello? Can you hear me? Good. So, we heard earlier, also from our Ghanaian friend, that one of the big opportunities in Kenya is housing. And if you look at the Kenyan market, it's something like a very small minority. It's about 11% of Kenyans can actually afford a market, even with the Kenya Mortgage Refinance Company's interventions, which have been significant in opening up home ownership to more people. But if you look at Nairobi, 90% of people in Nairobi rent. If you look across sub-Saharan Africa, in most major cities, it's above 50% of people who are renters for a variety of reasons. And affordability is one of them. So I think that, and if you look at South Africa, what we've seen, I think that the alternate asset class that will scale most rapidly across Africa, provided the financing can be corrected, is, and after logistics, is multifamily residential rental. If you look at and if you look at Kenya, what we see is most affordable housing and even policy supporting affordable housing is about home ownership. Yet 90% of people in Nairobi are renting. And affordable housing remains predominantly build to sell rather than build to rent. If you look at the study by ABSA and CAF and MSCI on multi-family rental residential in South Africa, it outperformed office and was second only to industrial, which I think Ragav would be pleased to hear. And there are a lot of reasons for this. Multi-family residential behaves more like commercial property. Tenant risk is diversified across many units. Vacancies are manageable. Turnover is rapid and quickly absorbed vacancies because of the demand. And assets can be managed and valued at portfolio scale. So there's a strong argument for it from a demand side and from how it performs. And Kenya shows this. The demand is there, but at the moment, it's really only Acorn outside of student housing. They're also looking at multifamily residential, rental residential and IHS. So it is emerging, but it needs to grow much more rapidly. And I think that's a question of how people look at financing the development of affordable build-to-rent.
Okay, thank you. Christabel, your namesake from Zimbabwe was here earlier. And if you remember the last time she was in Kenya, there were 2 REITs in Zimbabwe. Just as it will interest you to note, they came to Kenya, you give them our regulations. At the time you gave them, we had 3 REITs. Christabel went back, they have 4 listed REITs as we speak. She was telling me by the time she comes for the next one, they will have 8 because they have 3. Now, I spoke to a lawyer from Zimbabwe a while back to ask, how is it that you've got so much growth? What innovation are you doing? And he told me it is a factor of inflation. Look at what's happening in our economy. Look at how hard it is to get dollars out. Now, this is a sentence that I got from one of the REITs that listed in June. It's called STREAD Trust. They actually put clearly one of the reasons for people to invest is to hedge against inflation through rental, infused cash flow, and periodic asset revaluation. So in the Zimbabwean market, REITs are actually addressing a very real market need. So for Kenya, you talked slightly earlier when you were introducing yourself about certain innovations when it comes to owning rental real estate property. What do you think can be done to increase home ownership, not necessarily home ownership, but real estate ownership in this market? And you can start with what you're doing yourself.
So at Nesty, we are very bullish on the customer, simply because if you look at the entire real estate value chain, so a lot of focus tends to be on raising capital, building, but then the customer comes at the tail end. So essentially what, for us, our value prop to the customer is that they should be able to access credit at fairer terms, just as the same way as somebody who's salaried would. If you look at now the data in the market, realistically speaking, about 85% of the Africa workforce are in the gig economy. So you're looking at your freelancers, those are guys who are working on, for example, Upwork. You're looking at consultants, you're looking at entrepreneurs. So a very small population actually earn by a way of a pay slip. And unfortunately, the system has been designed in such a way that it only supports the 20% and leaves out the majority. Exactly. So in this particular case, for us, if we're able to show proof that somebody pays their rent and they pay it well, and that particular rent forms 40%, up to 40% of their income. So indeed, they do have a source of income. It's just that it hasn't been tracked, it hasn't been verified. Then with that, if they're able to approach the bank, then they should be able to get a mortgage facility, especially the affordable ones, backed by KMRC. Then over and above that, the beauty about it is that we now have KMRC that has introduced the Kenya Mortgage Guarantee Trust, which essentially also significantly reduces the risk, because we know the banks, that's the key thing, they're very risk averse. So even with this introduction of the guarantee fund, then essentially it covers 40% of the first loss basis. So if we're able to combine all those elements, which in this particular case, we can look at it in the form of blended finance, then that means we open up a very significant pool of that access to that credit to a significant number of people who then would be able to buy properties and increase uptake.
Thank you. Sean, I don't know if you're, do we still have Sean? Yeah, we do. Sean, you can put on your camera. Sean, if you can hear me. Sean, tap twice. Oh, there you go. Okay, so I want to ask you about proptech and AI. I was having a chat with Grima earlier. AI and proptech promise better decision making, better tenant experience, more efficient operations. But where are they actually creating value in today? When you talk to majority of us, all we know about AI is ChatGPT. So how do you bring that? Yes, how do you bring that into real estate? Just tell us first of all, what is proptech? What's this connection between technology and property? Yeah. Okay. Thank you, Sean. So, James, let me bring this back home. When Sean said quite a lot of significant upticks on the data aspect, whether it's analysis, but when we go to trustees, to investors, to talk about REITs to start, we have to start explaining what REITs. Now we're going to talk about AI and data. So when we bring it to the ground, how exactly is data something that investors or trustees or promoters, how is it that something that they should take into account, prepare for? Does it have an impact on transparency? How should they be looking around having the data conversation? Qua ground, as they say.
Thank you, Brian. For me, the conversation starts with an issue of transparency, right? So as a REIT manager, you are working cohesively with the investors, you're working cohesively with promoters, you're working to ensure that as a collective investment scheme, it's able to serve the purpose as regulated by CMA. And we cannot have or be in the same situation we have as Kenya in Africa as a country that is opaque when it comes to data information. So we need to be able to show our investors, we need to be able to have that conversation with them of what income we are gaining from this asset. And even in the investment masterclass, Raghav was speaking about robustness of income from your particular asset. So for us as REIT managers, can we have or can we analyze, make the correct assumptions in terms of rent reviews, in terms of WALE, in terms of CapEx, in terms of the operational side of the asset itself. And from that data, we are able now to grow trust with our investors, with our trustees, because they know these are service providers who are unshakable in their experience, in their expertise, and how they analyze the data. Once you have that in pocket, now we can start talking about technology. Because at the end of the day, tech is a tool. It solves problems, it gives solutions, it saves on time, it de-risks. But at the end of the day, it's a tool. Garbage in, garbage out. So if your assumptions are not on point from an expert perspective, if you don't have a correct view of the market, right, in terms of regulation, in terms of policy, in terms of tax, right, all those elements have an impact on the returns that I will promise an investor at the end of the day. Even for us in our tools that we are looking to develop in the market, that is our end goal. Can we have a verifiable and veritable asset, an investment model that can withstand the test of time, can, when battled against, what I call different scenarios, for example, like the Iran US war, which is currently affecting us at the moment in terms of fuel hikes, potential fuel hikes in the market. Can we be able to foresee such elements? And if there are changes in construction costs, changes in what I call rental escalations or rental freezes, how will they affect the investor and how can we be able to give them a buffer? So it's a significant conversation that we need to have from an expert perspective, growing up and giving the investors and other stakeholders that confidence. Yeah.
Thanks, James. Graham, I remember when we were talking about this and you'd wanted us to deep dive into tokenization, but I don't know if we have enough time for that. So I'll move to future cities. And I want you to talk about the experience with Tilisi. When we talk about future cities, are we talking about smart infrastructure? Are we simply talking about infrastructure that has been put in place well ahead of time? What exactly is future cities? And are we in a place where that is coming to the Kenyan market?
But just a little bit on tokenization.
Yes, you must.
No, it's actually for Paul, because one of the points that Isaac from Ghana raised is that for REITs reaching retail investors, it's proving more difficult. And tokenization really is premised on the notion that people can acquire maybe and traditionally into one particular property, but as a layer on a REIT, tokenization of REITs might well be something that's interesting for REITs, because there are a number of tokenization products in the CMA's sandbox at the moment that will come onto the market, and they are different from REITs. But to turn to future cities, and obviously a lot of what I'll say, it really is based on two things. The first is the fact that in terms of an OECD report, together with other parties, including Cities Alliance from last year, is that if you look across Africa, what you're seeing is smaller urban agglomerations being absorbed into much larger agglomerations. So the projection is that by 2050, which I just say is not that far away, if I live as long as Warren Buffett does, I'll be around to see it. By 2050, Nairobi will form part of this vast mega agglomeration of about 57 million people. And so when we think about future cities, we have to think very carefully about that. How are our cities going to function? And it's all of the things that you mentioned: smarter infrastructure, better connectivity, climate resilience, integrated land use. But I think the lesson from places like Tbilisi is that it's a different kind of philosophy, and it's actually moving from sort of unplanned expansion to intentional urban development. And that means very consciously thinking about your planning. And as you mentioned, putting in infrastructure early, because mostly when cities expand, they expand and then the city tries to catch up, and that's much more expensive and much more difficult. So it's really about thinking, and what places like Tbilisi can do is really drive that infrastructure and that integrated planning and that connectivity, so they're not islands within a fragmented urban form. And if you look again at places like Tbilisi, it was very consciously, before the term 15-minute city was popular, was thought about as a place that would be walkable, that you could ride around it. Within 15 minutes, you can be at the shop, you can be at your place of work. And that's very important in terms of reducing emissions. So it's not going to be about technologically driven smart cities. Technology will play an absolutely critical role in the planning, the thinking about infrastructure, but it's a much more disciplined approach to planning, to land use, to infrastructure development, and then managing it. Once the plan is there, it obviously will change according to market conditions, but being very conscious about what is happening in this place and can the infrastructure actually support it, so that you don't have what we all talk about, the killer leisures, the parklands, etc., that are fundamentally changing, which is not necessarily bad, but it's bad because the infrastructure was not thought about.
Thanks. It's interesting because we have one technology city, which hasn't moved in a number of years. And then we have, I think I saw Angela around from Tatu. Yeah. And then Triffic, I think, so we have more cities which are planned than the ones which are meant to be smart cities. Final question, because we've run out of time. I will give this to Paul, but any of you can chime in. And it's because, Grandma, you talked about what happens in the next 10, 15 years in Nairobi. What do you see in the next, if you look forward, 10 to 15 years, as being the key thing that will differentiate real estate platforms and urban developments? The ones that succeed versus the ones that get left behind?
That's a pretty broad question. But I think the answer lies in some of the responses you've just heard. And the first ones that, where sort of Graham left off is that, if we're just building because we can, I don't think we'll have future-proof cities. I think we have to start building towards master-planned developments that can scale. And we still have an opportunity. For instance, in most of our cities, the infrastructure has always been the constraint. If you look at Nairobi, the infrastructure is being built out. So areas which were far not long ago are now close. And there are opportunities to do Tbilisis and Tatus and stuff and still be 15, 20 minutes from town. So I think the promotion of sort of scalable master planned developments that are mixed income, that are mixed use, that are functional and aspirational schools, all that stuff is going to be a key factor. I want to sort of draw in the issue of technology. So much of what James said and Sean said was about the operational efficiency, and that's critical. I think that's the first and most critical stage of being able to be institutional. But sort of where Cristobal was going was, but we're also creating financial products, right, that can deepen access. And I think for me, the data and technology must be leveraged for the biggest disruption opportunity, which is access. Okay, and certainly we're experimenting with sort of lease to own schemes and financing schemes and solutions that mean that you don't have to rely on mortgage products. We have 30,000 mortgages in Kenya, 55 million people. If we double it, we're still, it's a drop in the ocean. So the ability to find financing solutions for people who generally won't have access to ownership is going to be a critical factor. And then I just lay in the last point, again, picking up from Graham's point, he sort of looked at me and said, we're the retail guys, we're the retail investors, and deepening the pool of capital available. Look, I have a slightly less popular, maybe, view on this, in that I think the institutions must come first. The market, for, if put up a slide and we put P over FFO, those sort of data points, you first have to drive the institutional investors into this market, and they have to be domestic. They have to be. We have to unlock the capital which is ready in this market. And if we do that, and if we build liquidity, and we have 20 REITs listed, all deepening, then the retail market will naturally evolve. It's just like the other products that have come to the capital markets. Today, retail investors have got exposure to many products on the capital, but maybe not REITs, right? So, if you get some of those things for me, if you can address those fundamental change agents in the market, then in 10, 15 years from now, this will be this Africa conference, we will not fit here. We will not fit here. You'll have to build a new venue in Tilisi for us to fit, right? So that's the ambition as far as I can see it. And I do feel, all the solutions, frankly, are in the room. Well, we don't have pension funds in that. Do we have local pension funds here? Any? Do you see what I mean? They must be here next time. That's our job as an industry, that the pension funds must be here, hanging on our every word and saying, what are you guys doing next? Not us running around chasing, because they have bad real estate portfolios, they think real estate is bad. That's the reality. That's the reality. Okay, so there is a change of mindset that as well, that we're responsible, those who are practitioners, it is our job and responsibility to change that perspective.
Thanks, Paul. I think the locals know where the pension money has been going this year so far. The products that have been in market. That brings us to the close of our session.